start with start. This is a company that I've backed, admittedly, very, very late. Very late. But look at what it's done. This is Oddbox. This is a brief summary. If you're in the UK, you may know who they are, but they basically do these boxes, delivery boxes of food. I'm a customer. I've been a customer for years. And they send out the food that supermarkets throw away. And, this is great story for, the younger people and people that care about the environment. And it's good food. It's not particularly expensive. I think it's maybe £15. I spend about £15 a week. And yeah, I think it's great. But look at how much the valuation has gone up, right? It's gone up from just over $1 million less than 5 years ago. And went out to 100 million. This has gone up 30x in less than 4 years. And this is the new fund rounding raise, and it's raised 7 million in less than a week. So, that's one arm of how well a company can do. I sometimes get asked, how well can angel startups actually do? Can you make any money? And the answer is yes. This is on the secondary market, so you can sell shares. And this has gone up 30x in, 4 years, essentially, 4.5 years. So, even a very small investment of, let's say 100k, sorry, let's say £100 would be, 3,000. £1,000 would be over 30k, 10k, 300k. You get the idea. Now, it's already worth 110 million. Actually, look at that. It's worth 100 there, and over here it's valued at 110. I think that's because this convertible round for this company values it a slight premium. Nevertheless, let's look at another example. This is at the other scale. This is a very new company, Seedrs, and it's basically saying that you can trade your unwanted goods. It's almost like a digital charity shop or a digital thrift store, and you can kind of recycle your home and personal goods with an app, and you can recycle and you get cheap things essentially. So, it's a circular economy type app, which I like. I love the circular economy companies. I've invested in a couple of them. They're getting traction. They have 13x their number of members. I'm not quite sure how many members they have. I haven't looked at their pitch deck yet, because they've only given away 3,000 items. So they may only have 3,000 customers. Nevertheless, they're a small company, 2.5 million. They're raising funds, and they're doing well. Will they become an Oddbox? 30x Oddbox? Who knows? That's a big question mark. I'm going to answer that at the end. Something else that's come up is the share market. I've been looking. I follow a couple of companies. One of them, probably most closely, is K-Box. I love K-Box. I think it's really cool. And I had a tab. Where has it gone? I don't know where. Lost it. Let's find it now. K-Box shares. Interesting thing about the listed markets is that price doesn't necessarily have a reflection on what is happening in the business. And it's down slightly on the day, 2% down. If this ever loads, I'll be able to show you how, the company's doing very, very well. And it's gone up about 50% in 3 months, from a low of, about 100 to a high of about 150p. It's gone up about 50% in 3 months, with the dividend still at about 5%. I'm an investor in this. This is I think it's my biggest holding. You can see what's happening, Profit's gone up from, I don't know what it was in 2020 and 2019, maybe 2 million or something, up to 7. So this is, I think, a very, very good value stock. If anyone's ever heard of Peter Lynch, a very, very, very smart investor, he always talked about the PEG ratio, which is the price to earnings to growth ratio, calculated by dividing the price to earnings divided by the projected growth in earnings. And he said if any company was growing, was less than 1, that was a good stock. And anything less than 0.5 was a fantastic stock. This is a 0.3, which means it is a very fast growing stock. He also said that if any company was growing at 50% profits or EPS, you should sell everything and buy it. And you know, Kate Box isn't far off that, you know, with 43% growth in EPS. So I think it's a really, really interesting, very, very interesting stock. There's been basically zero news in the last 3 months, but it's still grown 50%. I think it's because it's such a good company, and maybe people are starting to realize, you know, that it's cheaper now than when it floated on the stock market, and it's got hundreds of stores, and it's become very valuable in terms of cash flow, profit. Everything is getting safer. It's still growing in a recession. You know, it's defeated inflation. So, you know, where does this leave me? You know, you've got the potential high growth stories of startups, and then you've got good value in the stock market. You know, you've got Kate Box, which I've covered, you know, before. In one of my videos, I said, you know, could Kate Box 10x, and I believe it can. You know, it's not valued particularly highly at the moment in the market. I think their dividend's going to keep climbing every year. It's already, you know, I don't know what it is now, 4 or 5%, but you know, that's going to could be quite interesting in 10 years. You know, I bet that will be 10, 20, 30, 40% on today's money is the kind of dividend one might get in 10 years, should Kate Box grow like I think it's going to. I think that the thing about shares and startups is it is quite difficult to know which is going to do well. I kind of feel that once a company is listed and has annual reports, you can kind of grasp the value of the company, and it's a little bit easier for me to analyze whether it's going to do well. And for me, it means that it's easier to put in more money. I have a lot more money invested in Kate Box than in Oddbox. Funny that they both have the boxes. Kate Box is a retail store and Oddbox is not retail. So the similarity in names that's pretty much the only similarity, apart from maybe they're both in food. But nevertheless, I think that investing in shares is I think a lot easier. It's easier to analyze. It's safer. Are you going to get 30, 50, 100x on every investment, or even some of your investments in the share space? It's unlikely. It's unlikely. Can happen if you buy at the right price. I think now is a really interesting time to be looking at investing in shares. I don't have as much free capital for various reasons. Things are happening in my life at the moment. Can't talk about everything, but I do see a lot of value in shares, a ton of value in shares at the moment. I think the value in the property market hasn't been realized because I think there's room for the property market, certainly in the UK and probably in markets around the world, to fall. So I don't think the value has been realized in the property market, but I think shares have fallen, and they may still fall, but I think that it's only going to increase the value in the market. With startups, I think there's still, a lot of them are still, I would say, unattractively valued, i.e. they're valued a bit too high. Nevertheless, I think there's still going to be lots of value to capture in startups. The question is, how do you pick the right ones? And nobody, you know, I think a lot of people struggle with picking the right angel investments. It's as much luck as it is skill, and there's so many variables. You know, I've chosen, I don't know what it is now, 85 companies that I've invested micro amounts in, and a lot of them are doing well. 3 or 4 have gone bust. It's been just over 2 years, 2.5 years I've been doing this in the angel world. I've been investing in shares since 2007, and yeah, I've had some failures in the shares world, but they've been minimized by me selling before the worst case scenario. For example, I invested in Patisserie Valerie, which was ticker cake, and I'd liquidated before they went bust, but they did go bust. Likewise, I've had some successes, and I think my successes have been way better. You know, I invested in house builders in 2010 and 2011, and a lot of them, you know, went at 4, 5, 6x. I've invested in Domino's Pizza, which is a 10-bagger, and now I'm in Cake Box, which I think is going to be another 10-bagger. I suppose the difference is now, if for anyone watching that's interested in my story, is that I'm investing more now than I did in in Domino's Pizza, because then I was in my 20s. I didn't work for WhatsApp. I didn't have the funds that I have, or the potential investment funds that I have now. And because I fixed my mortgage in December 2021, which turns out to have been one of the best times to fix one's mortgage in recent history. I fixed all my mortgages then, personal and business mortgages. So I've got a bit of income to invest, but not a huge amount. Anyway, guys, I hope you've enjoyed this video. You know, I've gone a little bit more defined. I've talked a little bit more about certain situations, certain businesses. I do think, in summary, it's about the analysis. It's about the insights. In both cases, I think shares are a lot easier to analyze. But there you go. Let me know what you think in the comment section below. Remember, I do videos about all these different things: startups, shares. I'm going to start doing stuff about property as I see the opportunity expand potentially in the property market. Make sure to like and subscribe. Let me know what you think in the comments, and I'll see you guys in the next upcoming video, which is probably going to be recommended for you. Take care. Remember, the knowledge is power. Progress is everything.